Earning too much income after you start taking Social Security can make things really complicated. Let me explain. Oh yeah, remember, I'm not a CPA. I don't give tax advice. Make sure you talk to your CPA before you make any decisions. So in the month of July on the Retirement Answer Man podcast, we had a month-long theme diving into Social Security. Really a geek fest, but we tried to make it lots of fun. And David, one of our loyal listeners, emailed in and said, hey, if it's not too late, I got a Social Security question. And he wants to know, what income does the Social Security Administration look at when they're determining whether they're going to tax his Social Security benefits? He says that when he retires, he plans on having no earned income. The man's not going to work at all. But he's going to have about $75,000 in income from various investments. And then when he turns 70 and a half, he says he's thinking he's going to have about $50,000 in required minimum distributions from IRAs and 401ks. And he wants to know, what should I be looking out for? What could happen here? And so what I want to do is I want to approach your question in a three-pronged attack. Number one, I want to look at what do they consider wages. Number two, I want to assume that you're taking your benefits prior to full retirement age so we can understand the impact there, because there is one. And then number three, we're going to talk about what about after you reach full retirement and you're earning income, okay? Three-pronged attack. Attack number one, what does the Social Security Administration look at when they're trying to determine the impact on your benefits? Well, the best way to think about it is it's earned income of some sort. Income you're earning from doing something. So that could be W-2 wages, it could be bonuses from work, it could be any kind of grant you get through the work that you do, or it could be, if you're self-employed, net earnings from your business. That is what the Social Security Administration is going to care about when they're determining how they want to get into your benefits. Part of that is going to be required minimum distributions, right? Because those are earnings that you chose to defer sometimes long ago that have been growing tax deferred. And this is sort of when you have to pay the piper. When you take a distribution from your retirement account that's pre-tax, whether it's a 401k or an IRA, they're going to look at that as taxable income. Now, what's not included generally in this category that the IRS is going to consider? Well, good for you, David. Investment income is not something that they're going to take into account. Pension benefits, capital gains, inheritances, in other words, things that are more passive that you didn't earn through your labor, generally they're not included when the IRS or the Social Security Administration is looking at your Social Security benefits. So that's attack number one. So attack number two is, what if you choose to take your benefits prior to your full retirement age and you earn income? Here's what's going to happen. The Social Security Administration says that in 2018, if you have earned income over $17,040 for this year, that goes up every year, that they're going to take away $1 for every $2 over that amount from your Social Security benefit. So they're not just going to tax your Social Security benefit. Your benefit is actually going to go down based on that calculation. So let's do a quick calculation for David. If he earns $50,000, that's going to be $32,960 over the limit of what he's allowed to earn before they start tapping his benefits. And he's going to lose $1 for every $2 he's over the limit. So in that scenario, he's going to have his benefits decreased by $16,480. Ooh, that could be painful. So you can see the impact if you're taking Social Security early and you have a lot of earned income. Now, where does that money go? Well, it's a good news, bad news situation. The good news is David gets it back after he reaches full retirement age, because what they're going to do is recalculate what his benefit's going to be, and they'll take whatever amounts that they withheld prior to full retirement age and pay it back to him in dribs and drabs, really about 15 years. So it's not like you don't get it back, but it's a big impact, especially in early retirement. Now, let's get to David's end. Let's say he gets to age 70 and a half and he starts taking out his $50,000 a year. How is Social Security taxed on whatever earned income he's going to show, including distributions? Well, it really depends. It depends, one, on whether he's married or not, and then it depends on how much he's actually earning. So the way that they look at it is, if a single person, we'll assume David's single, if he earns between $25,000 and $34,000 a year of earned income, then up to half of his Social Security benefit can be taxable. And if it's over $34,000, up to 85% of his income, or Social Security benefit, could be taxable. Now, if you're married, you get a benefit. The brackets are, if you earn between $32,000 and $44,000, about half of it could be taxable. And if you earn anything over $44,000, David would be in this boat, up to 85% of it could be taxable. So there's your answer, David. Now, how much would be taxable? There's a link below to a handy calculator from the Social Security Administration that will help you figure that out and estimate it, because it's a little bit complicated. That's why they give us calculators. So you got to be careful. Yeah, we want to rock retirement. We got all this money saved up, but we got to be smart in how we take it out so we can maximize the benefits and not let the Social Security Administration get out our money. That's how you're going to rock retirement.